Hello everyone, welcome to our channel Intelligent Investor. In this video, we are going to discuss about return on equity, return on assets, return on investment, return on capital employed and debt to equity ratio. That is ROE, ROA, ROI, ROCE and D/E ratio. First, return on equity. ROE is a measure of how efficient a company is at generating profits. ROE is calculated as net income divided by total shareholders' equity and expressed in percentage. For example, let us take company A and company B. Company A's net profit is 10 lakh and total shareholders' equity is 50 lakh. Then return on equity is 20%. On other hand, Company B's net profit is same as Company A, that is 10 lakh and total shareholders equity is 25 lakh. Then return on equity is 40%. From this example, Company B is better than Company A because Company B produces more income with less equity. ROE shows the efficiency of company. Limitation in return on equity calculation is debt. If a company generates more income through the debt with less equity, ROE will be higher but the company's debt also be higher. So, no one can invest in a company by calculating single ratio. Second one is return on assets. ROA is a measure of how profitable a company related to its assets or the resources it owns. ROA is calculated as net income divided by total assets and expressed as percentage. For example, take company A and company B. Company A's asset worth is 10 lakh and generating net income as 2 lakh. Then return on asset is 20%. In company B, total asset is 5 lakh and net income is 1.5 lakh. Then return on asset is 30%. From this example, company B is better than company A because with less value of assets, it generates more income. Remind that manufacturing company needs more assets but service provider needs less assets. So, ROA is used to compare companies of same sector. Third one is return on investment. ROI is a measure of amount of return on an investment cost. ROI is calculated as net income divided by cost of investment and expressed as percentage. Next one is return on capital employed. ROCE is a measure of company's ability to earn a return on all of its capital employees. ROCE is calculated as EBIT, that is earnings before interest and tax divided by capital employed and expressed in percentage. Capital employed is equal to total assets minus current liabilities. ROCE is used to prove the value of business gains from assets and liabilities. It can be used to show how much a business is gaining for its assets or how much it is losing for its liabilities. Higher the ROCE, the better because the company is using capital more efficiently. On seeing ROCE of different companies is one way investors can compare companies and decide what to invest. Examining the same company's ROCE from year on year is also useful for spotting performance trend, that is stable or growing. For example, again take company A and company B. Both of the company's revenue is same as of 50 lakh. EBIT of company A is 4 lakh and capital employed is 20 lakh, then ROCE is 20%. But company B's EBIT is 2 lakh and capital employed is 8 lakh, then ROCE is 25%. From this example, company B is performing more than company A. Last one is debt to equity ratio. D/E ratio is a measure of company's financial leverage. D/E ratio is also called as risk ratio or gearing ratio. Debt to equity ratio is calculated as total liabilities divided by total shareholders' equity. For example, take company A and company B. company A's asset is 25 lakh, liability is 20 lakh and its equity is 5 lakh, then debt to equity ratio is 4. On other hand, company B, its asset is 15 lakh, liabilities is 5 lakh and equity is 10 lakh, then D by E ratio is 0.5. From example, company A pays 4 rupee for their 1 rupee, but in company B only pays 0.5 rupee for their 1 rupee. So company A is highly leveraged and highly risky. In case company uses debt to generate more income than debt value, what happens? It is benefit to the company. Here the matter is how company uses their debt. Always remember that it is impossible to take financial decisions by using single ratio. On next video, we have to see about remaining ratios. Subscribe for more. Thank you.